Bitcoin isn't moving because of Trump. It's not moving because of ETFs, and it's definitely not moving because of the news you're reading. Bitcoin is moving because of one mechanical process that Wall Street uses every single quarter, and if you don't understand it, you'll keep getting caught on the wrong side of the move. Here's the key idea up front. This has nothing to do with opinions or sentiment, and everything to do with forced institutional behavior. Once you see it, recent price action finally makes sense. Most people believe markets move on headlines. A politician speaks, price reacts. An ETF gets approved, price pumps. Bad news hits, price dumps. That's how retail investors think because that's what they're shown. But that's not how large markets actually function. News explains moves after they happen, not why they happen. The real driver behind Bitcoin's recent movement is quarterly institutional rebalancing, and almost nobody in crypto talks about it. Here's how it works. Massive funds, pension funds, endowments, sovereign wealth funds manage trillions of dollars using strict allocation models. These models don't care about hype or narratives. They care about percentages. A fund might be designed to hold 2% crypto, 20% bonds, and the rest in equities. When prices change during the quarter, those percentages drift. If Bitcoin rallies hard while stocks stay flat, crypto becomes overweight. That forces selling. If Bitcoin underperforms while other assets rise, crypto becomes underweight. That forces buying. These trades are not opinions. They are mandatory. Algorithms execute them whether fund managers like it or not. And here's the critical part. The timing is predictable. Most of this rebalancing happens during the final 2 weeks of each quarter. March, June, September, December. Like clockwork. Billions of dollars move based on math, not news. That's why Bitcoin often makes strange moves when there's no clear catalyst. It's not random, it's scheduled. Let me make this concrete. In December 2024, Bitcoin was hovering around $90,000. No major negative news, no panic. Then suddenly, price dropped to $85,000. People blamed sentiment, but the real reason was end-of-year rebalancing. Funds that were overweight crypto after earlier rallies had to sell to reset allocations. Algorithms were dumping, not humans changing their minds. This is where most traders get trapped. They see buying pressure and assume a new trend has started. But rebalancing flows are temporary. They last days or weeks, not months. Once the allocations are reset, the flow disappears. If you mistake mechanical buying for genuine demand, you'll get burned when the support suddenly vanishes. Smart money understands this. They sell into rebalancing-driven rallies and accumulate during rebalancing-driven dips. Retail does the opposite, and then wonders why the market feels unfair. So what does this mean right now? As we approach the end of December, Q4 rebalancing kicks in. Based on relative performance this quarter, many institutions are underweight crypto and overweight equities. That creates forced Bitcoin buying into quarter end. Not explosive, not emotional. Just steady accumulation driven by allocation math. That's why Bitcoin can grind higher without any bullish headlines. It's not optimism, it's obligation. But here's what invalidates this setup. If Bitcoin rallies too far too fast, crypto becomes overweight again. Then the same mechanism flips from buying to selling. The flow reverses, and price stalls or pulls back. The key isn't price levels, it's allocation percentages. If crypto rises above institutional targets, rebalancing turns bearish. If it drops below them, rebalancing turns bullish. Most traders never track this. They focus on charts and news while the real money moves silently underneath. This is why Bitcoin can rally on bad news and dump on good news. Headlines don't matter if algorithms are adjusting exposure. Once you understand this, Bitcoin volatility stops looking random. It becomes cyclical, mechanical, predictable. The investors who survive multiple cycles aren't the ones chasing narratives. They're the ones who understand when forced flows are pushing price and when those flows are about to end. Bitcoin is moving for one reason: institutional rebalancing. Everything else is commentary added after the fact. So here's the real question. If you knew exactly when billions of dollars were forced to buy or sell Bitcoin, regardless of news or sentiment, how would that change the way you trade?